In Tom Lee's most recent interview, he expressed a bullish outlook on the market and brought up many interesting points. And in this video, I'm going to go over all the points. One of the key reasons he cited is monetary policy. He believed that Federal Reserve will begin easing rate or easing the monetary policy again after 4 meetings of pause, which will help support and drive the U.S. market higher. Of course, that's if the inflation continue to decrease. Right now, based on the Fed funds futures, the market expect the Fed funds rate to drop 0.5% in the year of 2025 and to drop 0.75% in the year of 2026. Another thing Tom Lee mentioned is fiscal policy, right? So despite concerns over Trump's sending letters to foreign countries, foreign government, threatening significant tariff if no deals can be reached by August 1st, Tom Lee remains optimistic. He believes that the Trump administration's intent isn't to derail the American economy, it's not to derail the market, but to use this letter or tactic to pressure countries onto the negotiation table and ultimately come up with a trade deal with the U.S. that's going to benefit U.S. Right? The Trump administration is not doing this to benefit other countries. Right? So many are worried that the Trump's tariff policy will hurt U.S. companies by shrinking their profit margins because essentially they're going to have to pay some tax, right? And especially after foreign countries retaliate against U.S. and the businesses may have to absorb some of the added cost incurred by the tariff. However, Tom Lee pointed out that this margin pressure could be offset by cooling inflation. As inflation eases, input costs such as raw materials decline, helping improving the margins and counterbalance the negative impact of tariff. Okay, and another example would be a cheaper crude oil causing gasoline price to go lower, which means logistic cost will be cheaper. For example, transportation. Right. So pretty much, Tommy is saying the tariff risk is low. And there's also concern over Congressional Budget Office's estimate that the Big Beautiful Bill Act will add $2.8 trillion to deficit over the next decade or 10 years, which could trigger selling in the bond market and drive treasury yields higher. Right? Because if the government are expected to run a bigger deficit, they're expected to issue more bond. So there is more selling pressure of treasury bond, which means the yield is going to go up. And when the yield goes up, the financial conditions tightens. So it's harder for corporate America to do business. However, Tom Lee highlights some key oversight, which is the CBO doesn't include tariff revenues in their budget deficit estimate because they only account for whatever is legislated in the act. And tariff is not legislated in the Big Beautiful Bill Act. So if government collects an estimated $240 billion annually from tariff, that would total $2.4 trillion over 10 years, nearly offsetting the projected deficit increase of $2.8 trillion over the next 10 years. So pretty much saying the congressional budget increase has a low risk. Tom Lee also mentioned about market sentiment. He said the V-shaped recovery since April 2nd, which can be seen here, right? April 2nd is here, and the two crazy sell-off days, which $5 trillion evaporated in 2 trading days, is April 2nd, where U.S. and China essentially decoupled. Right? And Tom Lee is saying this V-shaped recovery right after that is the most hated V-shaped recovery on record, even more hated than the post-COVID rebound in 2020, because it's considered a bigger pain trade. Because many hedge funds and high net worth individuals were skeptical about trading this rally, right? So because they're so scared, they're so skeptical, they're so bearish, they missed the rally. And a lot of them actually bet against it. Right? They increased their short positions, which has intensified their pain. As a result, right, the shorters, they hate this V-shaped recovery. And this extreme negative sentiment actually may fuel the market higher in the future, because those who are on the wrong side of the trade, they're forced to cut losses by buying back stocks and adding to the upward pressure of the stock market. And right now, with the market being at all-time high again, Tom Lee is calling this the start of a new bull market, and he believes that the financial institution will soon need to shift their tone on the market. They can no longer say, worry about this, worry about that, fear of this and that. They should be saying some more bullish things, change their tone to a bullish narrative, and they will be acting more risk on. This is because the financial institutions are FOMO, or fear of missing out. Or they're scared of not participating in a bull market. So Tom Lee also mentioned about fundamentals. He believes that the market is due for a price to earnings ratios, PE ratios, multiple expansion, because since 2020, the year 2020, there has been 6 black swan events. Right? We had COVID, we had supply chain shock due to COVID lockdowns, and then we had inflation surge, and we had the most hawkish monetary policy from Federal Reserve. And then we had the April 2nd Liberation Day tariff shock. And then we had U.S. bombing Iran. Right? So there has been 6 black swan events, and market survived. Not only it survived, we're at an all-time high. But the S&P 500 equal weight PE ratio is currently at 16.9, which is actually 0.7 point lower than the pre-pandemic level. So because the market is able to survive 6 black swan events, which means this market is indestructible and it's super resilient. Tom Lee believes that this market deserves more PE, or a higher PE multiple, which means that there should be more upside ahead through this valuation expansion. And Tom Lee's most recent year-end target for S&P 500 was updated a month ago, which is 6,600. This implies a potential upside about 5.4% from the current level. Thank you very much.